Let me tell you a little secret. We did a full DCF valuation of Tesla stock right before earnings, and after the numbers came out, we actually had to redo it. And after the fix, our target price for Tesla got higher by $20. Hey there, and welcome to the Market Monkeys channel. It's Julia here, and today we will talk about better than expected earnings results of Tesla after very disappointing robotaxi event, predictions from some analysts that the stock price should go to about $85 per share, and our own DCF valuation that is much higher than that. All of this and more in today's video. Stick around to not miss what we are planning on doing with Tesla stock. So, Tesla's third quarter earnings report, let's just say things went much better than everyone anticipated. The company beat its expectations slightly, and today we're going to discuss what it means for investors and for future of the Tesla stock. So as always, let's start with the numbers. Tesla beat its earnings, posting a non-GAAP earnings per share of 72 cents, much higher than the 60 cents that was expected. They also reported revenue of around $25.2 billion for third quarter, which was slightly below Wall Street's expectations of $25.67 billion. This makes the streak of 4 consecutive quarters that Tesla has underperformed against consensus earnings per share estimates to come to an end. And as a result, Tesla stock went flying up 12% on the post-market and being around 11% plus on the pre-market on Thursday. Two things that we already knew about Tesla's third quarter before the earnings is their production and deliveries. In the latest update, Tesla produced around 469,000 vehicles, but delivered fewer than that, showing that inventories did increase during the quarter. Since automotive sales take approximately 81% of the company's total revenue, the number of EV units delivered in third quarter was supposed to provide strong evidence of Tesla's revenue dynamics, but it didn't. Even though we knew the delivery numbers before the earnings, analysts still overestimated how much revenue Tesla would bring in. Company grew at a solid single-digit rate, but analysts did expect to see around 10% growth year over year. Tesla's operating margin rose to 10.8%, which is much better than what Tesla achieved in the last couple of quarters, mostly due to the nice performance of the energy business and due to higher regulatory credit revenues, together with Tesla Cybertruck achieving positive gross margins for the first time. If you find this information valuable, don't forget to press the like button and subscribe to our channel. It really helps the algorithm to pick up our videos. The revenue growth was uneven. Tesla's core car business only managed a 2% increase, and with inflation still about 2%, that means the car business isn't really growing, and it's a concerning sign. I know that they're progressing nicely with energy generation and storage, and we will talk a lot about this today and even include this growth to our DCF, but still it's a little early to say that this segment will become the biggest. For now, as we can see, the majority of their revenues are coming from automotive segment, and this segment isn't growing as much as everyone would expect. By the way, another proof that Tesla is automotive company and not, as they're trying to sell sometimes, AI or energy company, is the fact that they're operating at gross margins of auto companies and not AI or energy companies. Here we can see their gross margins are being more in the area of General Motors and pretty far away from Nvidia's margins, same as with the Next Era Energy and First Solar. But in the same time, you will pay for Tesla stock much more in price to operating income than for Nvidia, for example. And if you think about this, it's insane, because Nvidia right now isn't the cheapest company on the market. Here you can see that all of the rest of the companies that we are comparing Tesla to are not even close to Tesla's metrics. It means that Tesla is still crazily overpriced right now. By the way, price to operating income, it's price to profit from the core business before interest and taxes. It's pretty similar to PE ratio. Although many of the analysts are agreeing on Elon Musk being known for overpositivity and overestimation of Tesla's capabilities, they may be very surprised this time, as in Tesla's presentation is actually written that preparations remain underway for our offering of new vehicles, including more affordable models, which we will begin launching in the first half of 2025. This is yet another reason for the stock to grow significantly, but there is one catch here. News about increasing operating margins by as much as they did are indeed very impressive. But what will happen to those high operating margins when they start selling cheap cars? And more importantly, what will happen to the stock of the company when operating margins start dropping? By the way, I don't say that they will drop, but I want to point out that the management of the company needs to work right now really hard on this energy generation segment, as this segment's margins are much higher than automotive margins, and to make up for the loss provided by the selling of cheap cars, they will need to do something else. And I assume this something else will be higher revenues in this energy generation segment. Now let's talk valuation. Tesla stock has been trading for sky-high multiples, close to 100 times earnings and 60 times cash flow. It's tough to justify those numbers when the company is struggling to meet revenue targets, even with aggressive pricing strategies. Some analysts think Tesla true value is around $85 per share, which is way lower than its current price. Even with more optimistic guesses like faster growth and better cash flow, it's tough to see how Tesla isn't overvalued. But not to be empty on the words, let's make a quick DCF valuation of Tesla stock to understand what is the fair value of the stock right now. Right after this, we will talk about what to do with the shares of the company. Let's start with the assumptions. By the way, it's the most important part because the end result mostly depends on what we're assuming on the beginning. So pay attention and see if you are agreeing on those assumptions or not. Revenues of Tesla come from three major segments. Revenues from everything that is related to auto in the future, also robotaxis, and everything that is related to cars. Basically, it will be included here. Revenues from energy generation and storage, and revenue from services. To create all of the calculations of the growth of the revenues, we need to take a base year. As we want to use the most updated information, we will take the past 4 quarters as a base year, or 3 quarters of this year and 1 quarter from the previous year. In auto segment, we are assuming a growth rate for the next 5 years of 13.8%, as this is an estimated growth for the global electric vehicle market. By the way, this assumption is pretty optimistic because right now Tesla is losing market share, and by this number we are assuming that they won't be losing any market share after this at all. After this, in the years 6 to 10, we're assuming that it will gradually slow to 3.3% and stay after this 3.3% after 10 years. It's actually EV sector median growth. Regarding energy generation and storage, currently the growth is 100%. We assume that Tesla will capture market share in the next 5 years, but starting year 6, it will grow with the market. It means that it won't be capturing any market share, but it won't be losing market share as well. And after year 10, we're assuming that it will grow 3%, approximately the growth of the economy. In third quarter 2024, the services grew 29%, and we will assume that this is what they will be growing in the next years. After that, in the years 6 to 10, we are assuming that it will be growing same as revenues from auto, because basically services, it's all of the charging stations, and as much as the demand for cars will grow and more cars will be on the market, the demand for services will be pretty much the same. And after year 10, we are assuming that it will grow the same as auto revenues. EBIT margin, or earnings before interest and taxes, currently for the past 4 quarters is 10.15, which is greatly affected by the last quarter's result. Pay attention, we want to be really optimistic here and to assume that the cheap cars production won't kill the margins and they will stay like this for the next 5 years. After that, in the years 6 to 10, we are assuming economy of scale for current production, Cybertrucks and cheaper cars. So that's why we assume here 12%. And after year 10, we have very optimistic assumption that Tesla will be fully optimized in production and the margins will be 15%. Regarding tax rate, we are putting 20.8% instead of the usual 25% because Tesla always gets some subsidies from the government or tax breaks. But of course, we cannot leave it as it is forever, because at some point they won't have these subsidies and they will need to pay the regular taxes. So after year 10, we are assuming 25%. So after calculating all of the numbers, we can actually see the expected total revenues for Tesla for the next 10 years. Here we can see that EBIT margins are the same as we discussed before that, and in the next column you can see the calculated EBIT in dollars, or earnings before interest and taxes, and the column after this, it's net profit. Here we also calculated earnings per share. It won't be a part of our DCF, just so you can see if our assumptions make sense to you or not. In the past 3 years in general, Tesla reinvestment was about 4.2% of sales, and we will keep it that way. And here we're getting to the free cash flow. To calculate present value of the free cash flow, we need to calculate weighted average cost of capital. As a risk-free rate, we are taking 4.25%, but this is actually T-bond yield for 10 years. Tesla's beta is 2.3. You can find this information on any website like Yahoo Finance, for example. Equity risk premium currently is 406%, and this information you can simply find in Google. Based on all of these numbers, cost of equity is 13.59%. Cost of debt of Tesla is 5.08%, and the debt weight is very small, around 1.78%. So we're getting to weighted average cost of capital of 13.43%. So this basically will be our discount rate for the free cash flow. Present value of the cash flows for the 10 years is about $54 billion, and the terminal value is about $316 billion. From this we are subtracting the debt and adding the cash, and after this we are getting to the value of equity of $416 billion. We will divide this number by the shares outstanding by 3.5 billion shares, and we are getting to the value per share of $119.25. So we're seeing that Tesla is being overvalued by about 50%. And people, I hope you saw that we were very optimistic in our assumptions. Tesla will need to work really hard to achieve the numbers that we have assumed. Based on this, of course, I can't rate Tesla as a buy, but I won't short this stock either because investors simply love this company, and despite the overpriced, very high valuations, the stock still can go higher in the price. Anyway, great performance this quarter. Congrats to all of the Tesla investors. As always, what to do with the info provided in this video is up to you. My job is to bring relevant and important information and to explain my point of view. Write a comment so I know that you're real on that side of the screen. I hope this information was helpful, and if it was, you can help us by pressing a like button and subscribing to our channel. I'll see you on our channel next time. Happy investing!